Yeah, definitely.
The hour of recollection.
And can everybody speak in their microphones so they can be heard? Okay. Jeez.
Okay.
Joking.
Well,
Do anything? Ryan, are you ready?
we will call to order the Police and Fire Pension Board meeting for February 28th.
Oh, shoot.
We have the attendance noted, or do you want to do a roll call?
Whatever you please. I've who everybody's here. Yes.
Okay,
Okay.
close enough.
All right.
Move this along. Look for a motion to approve the agenda for today's meeting.
I'll make a motion.
A second.
Okay, we have a motion and a second to approve the agenda. All those in favor?
Aye.
Aye. Opposed? None. We'll move on to the approval of the minutes from the November 15th, 2021 meeting.
I've read them. This is Ed. I'll make a motion.
I'll second.
Okay, we have a motion and a second to approve the minutes of November 15th, 2021. Is there any discussion at all? Hearing none. All those in favor?
Aye.
Opposed? We will move on to the actuarial valuation report for June 30th, 2021. It's all yours, Derek.
All right. I feel like I have to make introductions since I'm speaking into a microphone. And it's being streamed online. So my name's Derek Henning. I'm from Gabriel Roeder Smith & Company, and I'm here to present the actuarial valuation report. And I always start out this way. But first, I'll let you know which page number we should start on. So I'm just going to flip directly to page A2, and that's the contribution development, the development of the contribution rate. But first, there are two main purposes of the actuarial valuation. The first one is to develop the contribution rates that the retirement system or the city rather would make a contribution to fund the plan to be able to pay out the benefit promises that were made. And the second purpose is to measure the funded ratio or the funded status of the plan. So that's just essentially just comparing the assets, which are usually investments, cash, against the liabilities. So the number that is the present value of the benefits that are owed to your members, to the retirees, and to the future benefit promises that are made to the active members. So on the page that I had you flip to, which is A2 of our evaluation report, is just a breakdown of the contribution rate. So the city makes contributions as a % of payroll. So similar to, 401ks are very popular now. You'll make payroll contributions, or I guess a great example would be Social Security. Those are payroll contributions. It's 6.2% of pay. And your employer makes 6.2 and you make 6.2, so that comes out of your paycheck. In a similar way, this is how these contribution rates are applied. So there are a few components to the contribution rate, and the first is the normal cost. So the normal cost is just, it's always going to be a contribution that needs to be made as long as there are active members in the workforce, because that is the cost of accruing a year of service. So, you get, in part of your benefit formula is years of service times a benefit multiplier percentage times your final average salary. So, as can be expected, as you accrue service, there's accrued benefit that needs to be paid out by the retirement system. So your liabilities will increase each year. So that's the normal cost. It's always going to exist unless, well, we won't get into that unless I'll try not to get too technical. And if I do get too technical, tell me. But anyways, that's the normal cost piece. And then the other piece is the amortization payment. So if there's a shortfall between the assets and the liabilities, that needs to be funded somehow. And it works in an amortization. It's kind of like a home loan. 30-year fixed rate mortgage, you pay a certain dollar amount each year. This is a little bit different because you're paying as a percent of payroll. So as you expect payroll to increase, you would expect your yearly payments to increase also. But there's that component to the contribution rate as well. Another component is the member portion. So depending on the bargaining group, they will pay a certain amount towards their pension. And the weighted average of that this year was 10.68%. That's up from last year from 10.2%, and that's because one of the benefit changes that we recognized this year was an increase to the member contribution rates for these various bargaining units. And overall, the contribution rate's pretty stable, and there was a decrease. So as you see at the bottom of this page, 2021 on the right-hand side, 35.6% was the rate developed last year, and this year's 34.87%. So that's a slight decrease. And one of the main drivers behind that decrease was investment returns, which were extraordinary for 2021. That helped lower the contribution rate a bit. There were offsetting elements as well, and we'll go over that a little bit later in the report. But that's the big reason why we saw a decrease. And another thing I'll touch on right now is that when there were these investment returns that were extraordinary for 2021, but we don't, as actuaries, we don't recognize the full asset gains that were experienced during the year. We just recognize 20%. We recognize a bit, and we save the rest for later. And then hopefully, if everything occurs according to our expectations, and that would help reduce the contribution rate and improve the funded status overall or in the future. But if there's any adverse experience, that would offset the gains that we're kind of padding for the future. So they would help offset any future losses. But with that being said, I can turn to page.
Mr. Chairman, can we ask questions as we go along? Would that be helpful? Is that okay? Sure. Just one question on this page. The amortization payment, which is meant to essentially cover the unfunded liability, right?
Right.
Over what time period would this assume? So if you put this rate in, over what time period would you correct the unfunded liability?
So 25 years, I think, or it would be 30 years, because as the amortization policy that the retirement system has been utilizing is
I believe it's 30 years.
It's 30 years, and then there's as gains and losses due to, or as assumption, if there's an assumption change, then that impact is amortized over a new base, so over a new 30-year base. If there's a benefit change, similarly. So everything will, but overall, the main chunk is going to be 23 years. And we can turn to that page next, and I can, but did you have a follow-up question?
Yeah, just to follow up, do other pension plans in your experience use the 25 or 30 years as well to amortize their unfunded?
Yes.
Okay.
And I would also say that one of a topic that's been, I guess, cropping up in the actuarial community over the last few years has been the idea of negative amortization, which exists when you are contributing as a percent of, when you're amortizing as a level percent of payroll. So negative amortization essentially is the interest that's accruing is growing at a faster rate than the payments. So you'll actually see unfunded increasing a little bit if the amortization period it depends on what your assumptions are, but if the amortization period is long enough, you'll see that phenomenon. And then, as it gets down to 20 or 19, 18 years, then that will typically cease. And it depends on what the assumptions are. But we would prefer, as actuaries, or we would recommend usually like an amortization period of 20 years or less. But 25 and up to 30 years is typically is an acceptable practice.
So if you prefer 20 years or less, why are we using 25? Is that our policy? The
Yes.
city's policy, or is that our board's policy?
That would be the board's policy. So in our view, if you accept the how should I put this? It is the board's policy in our view, and that's what we've been following, that policy, and that we've been for, I guess, several years now.
Okay, thank you.
I believe it's been since the inception back in the 60s.
It could
If I
be.
remember right.
We have a base that was originally 30 years, and there's 16 years remaining. And bases, if it's been, obviously, if it's been since the 60s, then some of those bases have been over. But yeah, but in our view, it is board policy, and and one of the things I'm going to recommend today, or that we recommended in our report, was an experience review, and funding policy would be one of the topics we would go over and show potential differing scenarios.
Okay. Thanks.
Derek, real quick. When we're talking about like the smoothing period, the 5-year smoothing, does everybody using that, or does some people use less, like a 3? Does some people go up to a 7, or is 5?
4 and 5 are the most common.
Okay.
I've seen 3, but 4 and 5, it's kind of a coin toss between those two.
Okay.
I would say, yeah. So I will just continue going sequentially through the report, and I'm currently on page, let's just go, I'm sorry, A4, because I wanted to touch on the history of your funding, the funded ratio. So we've gone over the contribution rate, and the next piece that we address in the valuation report, or we address many things in the valuation report, but the next main piece is the funded ratio. So in 2021, the funded ratio on a funding value basis, and it seems that we all understand the difference between the market value of assets and the funding value of assets. I'll go through that difference briefly in a moment, but using the actuarial value of assets or the funding value of assets, the plan is, or the retirement system is 78.7% funded. And that's an increase from 75.7. So 3% increase from last year. Obviously, trending towards 100% is the goal, and that's a good funding progress year over year. And now I'll turn to, with everyone, to page. Did I skip it? I may have skipped it. But it's the, see, this is why I need to, what happened here? Please bear with me. I apologize for the delay. But it's was it 8? Could you please go to 8, please, Tracy? I think it is. I think I had a page out that slid behind everything else. There we go, right there. So this is, so on the top, there's a value that's about $186 million. That's the market value of assets under the 2021 column. And if you go almost all the way down to the bottom of the 2021 column, the funding value of assets is $166 million approximately. So that $20 million difference, that's going to be realized over the next 4 years. So we've recognized the first year of this investment, of the investment performance for this year, and then we have other prior gains and losses below that as well. And everything that's, as the columns start to look empty under 2022, 2023, 24, 25, those are the future gains that we are planning to see. And if there's any market fluctuations, then things will start filling out that way. But right now we have a $20 million like buffer, so to speak, that would help offset any future losses. Or, you know, it'd be great if everything occurred according to our assumptions, and then we would just see, you know, funding progress accelerate. So I always try to remain hopeful.
So you're essentially saying that's upside to where the 79% is that we're currently funded. If
Right.
the market holds, our portfolio holds at 186, we gradually realize this.
Right, and another way to look at that too is that if you just used, if we were to use the market value of assets to calculate the funded ratio, the retirement system would be 88% funded. And I guess,
Yep, that's what I was looking for. Perfect. Yeah.
and as sort of a wrap up, I'll open up to discussion as well. I'll go to page A12. So this is the comment section, and essentially we've gone over the experience for the year, and that really the remarkable thing for the experience that occurred during the year was the investment returns. And also too, there were benefit changes that were valued for this valuation that were recognized, and that was there was a bargaining group that's now eligible to participate in the DROP, the Deferred Retirement Option Plan, or the program. It's either or sometimes. And then the other changes that were recognized were increases to the member contribution rates. So that had a very small impact on our calculations, but it is something that we value this year. And the other thing we reviewed, and we have to review every single year, is well, I'll start out like this. Actuaries, we are bound by actuarial standards of practice. So in one of those standards of practices, we have to make sure that all our assumptions are reasonable, or all of the retirement system's assumptions are reasonable for the valuation. And we review, you know, on a higher level your assumptions, and one of the assumptions that is very important is the investment return assumption. And I will say that for 2021, we believe all assumptions are reasonable. But we've also seen we've seen capital market expectations begin to decline. And even though we had this great year, and there's also this concept of reversion to the mean and that's, you know, if you have a big return, then some of these investment firms start baking in like a potential loss, and then you see these capital market expectations decline. So we are recommending that the board perform a experience review, and I passed out a letter that's dated for today that outlines what we would do during an experience review, so the scope of services and also the proposed fees. So I'll go through that really quickly. after this next comment, I guess. So another reason why it'd be advisable to perform an experience study is because as there was a legislation passed a few years ago, Public Act 202, and part of the stipulations of that act was that the retirement systems in Michigan have to have an experience study performed every 5 years. In the last experience study for Battle Creek Police and Firemen's Retirement System was performed, or it was issued and dated March 11th, 2015. And so if the board were to have us do an experience study, this would be the first one that would have been performed since this act has been signed into law. And then it would keep Treasury happy for another 5 years. But anyways, page 1 of the letter that I passed out, the fee letter, has a background, and the components of the experience study would be, we would be reviewing the investment return assumption, patterns of pay increases. So there's an assumption of how members' pays are going to increase throughout their career, and that's used to project their potential benefit when they retire. Rates of mortality, we would be using newly published tables, or fairly newly published tables, that are actually public sector specific and public safety specific mortality tables, which is pretty cool. We haven't seen mortality tables develop like this before, so it's kind of cutting edge. But it's made from public sector experience. All the other tables were private sector experience, so this would kind of, it makes sense to use them. We kind of geek out over that kind of stuff more so than you guys. But rates of withdrawal, so that would be rates of terminations of the active members, and rates of disability, and rates of and patterns of retirement. And on the next page, we touch on that we would update the mortality tables based on what are called the Pub 2010 tables, and more specifically the Pub Safety 2010 mortality tables. And we'd review the economic assumptions, and we would evaluate the impact on the plan if we were to adopt these recommended assumptions, and funding policy. So the funding policy would also be something we'd touch on. We'd look at different amortization periods and how that would impact the contribution rate. And the fees would also include a board meeting that we would present the results. And the study would take about 6 to 8 weeks and would cost no more than $6,000. And I realize I just passed this out today, so it's at the board's discretion if they would like to address this particular item at this board meeting or a future board meeting. If there's any questions, I'd be happy to address them right now. Sometimes I don't have the best wrap up, so I end really abruptly. But I think opening up to questions would be a good way to wrap up.
Does anybody have any questions?
Yeah, I guess me again. Thanks. I'd like to ask your thoughts. You mentioned in the report that the 6.5% investment return assumption is on the aggressive side of the range that you currently have for the market returns. I guess 2 questions. One, does that take into account asset mix? I'm assuming you take that into account in your investment return, right?
Right. So what we do is we look at your asset mix, and then we have our own model that is informed by 12 investment firms. We update this every year, and we look at their investment or their capital market expectations. Yep. We kind of plug them in and look at them.
And then what is, if you had that or look at that together with our asset mix, what's the range that you have?
So the range that we would have would be, and it's not exact, because and also too, it's off the top of my head, but we would, yeah, I can't quite remember that. I can't remember a specific mix, but if it were closer to 6%, I think that would be more within our range. And there's other things to consider as well. Like our model isn't the end all be all. You have your own investment firms consulting you, and so those are other things we have to take into consideration. Also as well, another big consideration that kind of that makes 6.5 a little bit more, I guess, in our perspective, like palatable, would be that $20 million. That's
Yep.
the difference between the market value
Yeah,
and
what you call the buffer, yeah.
Right.
So since you're saying 6%, ours is 6.5, it sounds like you have a tight range, like 5.5 to 6.5 roughly?
It would be, it depends, but the range could even be 1%. So 0.5% to 1%, 5.5 to 6. That would be within range that we consider reasonable. I will say this, that a lot of times we'll say well, we have a preferred assumption, and that's usually a lot lower than that's feasible or practical for the retirement system to go, but we have a range as well. So if we were doing the experience study, we would present to you kind of our preferred assumption, and then we would say, but we have this range. So it could be, yeah, I'd say 5 to 6% roughly. Don't hold me to that. But yeah, like.
No, it's 5 to 6%, we're not in your range. You said we're at the aggressive edge of your range, so I hope the range is at least 6.5.
It is. That's what I'm trying to say. Like, you're right. Let me amend my statement. 5 to 6.5% for right now. But when we were looking at these numbers for the experience review, we would probably. It depends on when our new model comes out too. So like, hopefully, like things might change a little bit. But yes, up to 6.5% for 2021 valuation, and that's kind of. But I will say that's kind of that's on the edge for us, and for us to consider like. Let's see. If capital market expectations were to continue to decline, and it'd be hard for us to say that 6.5 is reasonable for the next valuation.
Yep.
So that's how I'll put
It'll
it.
change every year, so
Yeah.
your outlook, sure.
So the other lower numbers that I was kind of throwing out, those are more, and I can't say exactly with confidence what these are. I don't have the numbers in front of me, and we didn't perform a formal analysis. And that's what we'd be doing with the experience study. But those are kind of like, I don't know, those are just kind of more feelings than anything. So yep, don't hold me to those numbers. And that's not necessarily a satisfying answer, but I also don't want to say anything that's incorrect. So
I'm assuming that after you completed the study, you did come up with 3-4 scenarios,
right.
giving us options.
Mm-hmm.
Because I think the last time we did that, one of the considerations was the city's contribution rate. I believe, I could be mistaken, I thought we, at one time, had a 7% return on investments because it was over a number of years, and we were doing pretty well. And we actually lowered it, which I think bumped up the city's contribution rate.
Yeah, it was 6.75 before 6.5.
Yeah.
I'm not talking in the mic, but that's what we have in our notes. And Stan, I think it was 7 before that.
Yeah.
I just got a question on page C13. And it's just going over the age of the members or what your assumptions are for the members who are in the plan and when we're planning on them retiring. And just notice that they're going up pretty high. I just want to know kind of how we got those or how you get those assumptions. Is that from just a generic retirement system, or is that from fire systems specifically, or police and fire systems? Once we get it all pulled up, I'll give you a chance to get there first.
So you're looking at the rates of retirement?
I'm looking off to the left. It'd be the percent of active members retiring within the next year.
Yep.
And we see that, like in the IAFF and police, they're starting at 60 to 61, and it goes all the way up to 75 plus. But in our system, they can't be over 65 years of age. That would be the max attainable age in this system. So what effect on our funding ratio, or what would that change for us? Does it have a big impact at all on how we're coming to our numbers and the conclusions in here? Because they could never be over age 65 in this system.
That is per Act 345.
So if we were to lower the retirement rates or have somebody retire 100% probability at age 65. And I guess to answer your question, that these rates are usually based off somewhat more widely published table or like a larger retirement system. And we would look, and that's something we'd also do during the experience study, is like this is we would consider not only your benefit provisions and your eligibility provisions, but some larger policemen and firemen retirement systems. How much of an impact would it have? Well, if somebody's retiring 30, if you imagine one person as like a fraction of a person, let's say, and they're going to retire at 35% 1 year, and then and then you're shipping, it's like, okay, then they're 35% gone, and then, or this is not a good way to communicate it. It's actually, but with these 35% rates, by the time you get to 65, there's not much left, so it wouldn't be a huge impact.
Okay.
Those are pretty high retirement rates initially. But yeah, so there are two things to consider with retirement rates. If you're projecting somebody to retire earlier, that could potentially increase liabilities because they're being paid a benefit for longer. Right. But at the same time, they're not getting pay increases and stuff, and in that way, having a higher benefit. So they're not accruing a higher benefit from the virtue of being there longer, getting paid more. And
yeah, I think it'd be something helpful to look at, especially if we've got new public safety mortality tables to kind of go along with the experience study of where our members are actually retiring, what their age and years of service are. That might be helpful to see to tailor into the plan. So.
Anybody else have any other questions? I'd kind of like to move on to what the board thinks about having the study done. It sounds like we're a couple of years overdue, and I think it would be to our benefit to have it done so we comply with the law.
I agree. I'd also like to see, so that last one was done in 2015, so that was about 3 years into the two-tiered pension system that we went to. So I'm curious to see if that's tracking in the direction that we want it to be, and that's the right way to go about it. So hopefully that'll be something that's pointed out in that.
Yeah, I agree. I think we should do a study. I'd like to probably bid it out to different actuarial firms, get different opinions and perspectives, and check in with Linda Morrison, who gave us comments at the October meeting, I believe it was, about an alternative vendor she was suggesting we consider. It was Watkins, Ross, yeah.
Well, I think the city would want to have that bid out. I think we kind of follow along with the, on the audit, with whomever the city's auditor is, who also do the audit for the pension fund.
And they would do the experience study as part of that? And
The auditing firm, or, I don't know if we want to bid out the actuarial services, I would assume that the experience study would follow right along with it. That's what I'm assuming. I mean, if we have an experience study done and then bid out the actuarial services later, they may have a whole different idea.
well, I guess whoever is going to do our actuarial analysis this coming year, for 2022, I'd suggest we have that firm do the experience study as well. And I'm just not assuming that it's going to be GRS. It could be another organization as well. I think we should consider another organization as well.
Yeah, there's quite a few out there.
Yeah. And I think what Linda had said she was going to do, I believe, was to check into other firms like Watkins Ross and see who else they had worked with in the past to make sure.
Towers, Watson, and they just merged with somebody else again. Yeah.
Linda,
Unfortunately, Linda's on vacation
I was gonna
till
say.
middle of next week.
Well, we can check back. I don't think we need to make that decision at this meeting.
No. No.
My thought, I think it's important that we're really comfortable with who we choose to go with here.
Yeah.
Because whoever, if you're going to do it, you're probably, and you do an experience study with me, you're probably not necessarily locking in for the next several years, but it would be helpful, right? To do the experience study with the ones who are going to be doing your actuarial analysis for the next several years.
Okay. So we want to table that for now?
I would suggest it, yeah. I would not have a motion on this.
Okay, how do you gentlemen
Other
feel?
people's opinions, but
I agree.
Okay. Food for thought. But we know we have to get it done, so. If nobody has anything else, thank you, Derek.
You're welcome. It's great to be here.
Okay. Next item on the agenda is the bank summary of assets and expense reports and the quarterly bank statement summary. Well, which one's going to give us that, Courtney or Tracy?
Okay, so we have quite a few different reports here since we haven't met since October. So the first one is from November 30th, comparing the portfolio, which was 186 million, and it shows a loss of 2.5 million compared to the October statement. And as you can see, for November, there were just $30 of miscellaneous admin fees for investment. And then our next statement was December 31st. The market value portfolio was 190 million, with a gain of 3.4 million compared to our November balance. And in the month of December, the expenses were, I had another miscellaneous admin fee for non-investments of $10. Our Gabriel Roeder Smith actuarial service was $2,700. The City of Battle Creek administrative fee was $3,000. Our auditing final fee was $7,350. And the MAPERS membership dues for next calendar year were $200. And then for our statement ending January 31st, our market value portfolio was 182 million for a loss of 8.2 million compared to our December balance. And then again, we had administrative fees of $10 and our Comerica quarterly fees of $13,969.75. All right. And then here is the quarterly bank statement for October, November, and December. Our beginning balance, as you can see, for the prior quarter was 186 million, and the ending quarter was 184 million. You can see our contributions for the quarter for employers was 1.5 million, and employees was almost $400,000. And then for first quarter, again, at the end of January, our bank balance at the beginning of the year was 190 million. Again, our employer contributions were 526,000, employees 205,000, and our ending balance at the end of January was 182 billion. Any questions?
I have none. Anybody on the board have a question on those? They're pretty much generic from month to month as to our expenses and revenues are. So I'd entertain a motion to approve those reports.
I'll make a motion to accept the bank summary assets and quarterly bank statement.
I'll second.
Okay, we have a motion and a second. All those in favor?
Aye.
Aye.
Opposed? Those are approved. We'll move on to board administrative reports. I have nothing. Tammy?
The only thing I was going to bring up is I received an email from MAPERS about some future conferences. I know that with the pandemic, a lot of us weren't able to go to any training or attend any conferences, but I just wanted to let you know that some of them are published if anybody's interested in going. The next one that I show available is the spring conference, which would be May 21st through May 24th at the Grand Traverse Resort. And then the fall conference is September 17th through the 22nd at the Grand Hotel in Mackinac Island. So that's really all I had.
Okay. Ed, do you have any?
So I was just going to add to that. So what are our, I think we have guidance from our policies, from the board policies on who should attend, how often. You know, obviously new members should attend within either 1 year or 2 year, and then, I don't know, it's been probably 2 years since I've attended now, so.
I think we're
with
all
COVID.
probably due.
That's what I'm thinking, yeah. So I guess there's, Tracy, could you just give us the guidance on that if you get a chance? Send out an email and just say,
Sure.
FYI, and I don't know if anybody has any tracking on how long it's been since we've done it. Courtney's nodding, we do, cool.
We do.
Let us know, give us a little bump and say, okay, guys, back on board again, and,
Sure.
yeah, thanks. I don't have anything else, Mr. Chair, thanks.
Okay. Yeah, I know those dates sometimes, they bump up against, I have a other conflicting convention I have to go, and I'm
And,
a recording secretary, so
I did two in the spring, but I think I could attend the fall.
yeah, the fall one looks good, because I think our other fall convention that I have to go to is in October, so. Tracy, Courtney, I know that you've got things, you always do.
We do. It's been a busy last couple of months. I'm just going to kind of go through the things that, of individuals, and then I'm not going to read all the resolutions for you. You can approve those. But Chad Perry, he was a police officer terminated on 12/31/21. A letter regarding his options for withdrawal was emailed on 1/20/21. And this is a little bit of a change since I'm kind of doing this from home. I've been sending out emails instead of sending out actual letters. So just so the board knows. Jerry Billknap was a police officer terminated on 11/26/21. And again, a letter regarding his options for withdrawal was emailed on 1/20/22. Veronica Granados, police officer terminated on 1/7/22. A letter regarding her options for withdrawal was emailed on 1/20/22. Ron Hattis passed away on 11/16/21. His 12/1/21 payment was returned and replaced with a prorated portion for 16 days in November. His final payment of $1,720.65 was paid on 12/15/21. Calvin Harding exited the DROP program with a retirement date effective 12/25/21. Total benefits and interest totaled $201,755.35, less a 5% of interest earned, $292.75, less early withdrawal payment of 10% of interest earned, $585.50. The remaining balance of $200,877.10 was requested to be rolled over, payable to Vantage Point Transfer Agents 457. This payment was issued on 12/28/21. His regular monthly benefit payments of $5,190.67 will begin on 2/1/22. An off-cycle payment dated 1/07/22 for $1,172.08 reflects a prorated portion for December, which was for 7 days. The military purchase was approved at the 1/18/22 commission meeting. Bush McCarthy, Fire Lieutenant, purchased 12 months of service time. He will be responsible to pay $9,560.99 to be added to his accumulated employee contribution total. Mariah Arid, former police officer, withdrew her contributions totaling $2,118.49. This total consisted of $2,118.49 in pre-tax contributions and zero in interest. A payment was issued to Ms. Arid on 2/14/22. Everett Landfer, former police officer, withdrew his contributions totaling $16,801.24. This total consisted of $16,519.48 in pre-tax contributions and $281.76 in interest. And a payment was issued to Mr. Lamfer on 2/14/22. Chad Stuck, firefighter, retired on 1/26/22. And Carney Green, police officer, terminated on 1/22/22. And a letter regarding his options for withdrawal was emailed on 2/14/22. And then we have several resolutions that need to be approved.
I'll make a motion to approve the resolutions for Justin, Mingle, Grafton, Bentley, and Smith, which I believe is all of them.
Yes.
Okay.
I'll second.
We have a motion and a second to approve the resolutions as presented. Is there any discussion? Hearing none. All those in favor?
Aye.
Aye. Opposed? They are approved. Jake, do you have anything?
I do not.
Chris?
No, nothing from
Okay, new business. Jeremy, would you give the report from Cap Trust on our investments?
All right, thank you. Good to see everybody. It's been about 2 years since I've been here in person, so. Brought back the iPads. If you just hit the little logo in the top right, you'll see 9 little mini squares. That's a quick way to really navigate to different pages. Obviously, I think Tracy, I'll be sure to give you page numbers as well to show on the screens, but I will go ahead and start with page 5, which you should see it says market commentary on the top. And as a reminder, this is actually we're going to start off with the fourth quarter report here. Then I'll give you more updated numbers as we move along. As you know, it's been an eventful start to 2022, so we don't want to leave that out as well. But to start on 2021, I'm just kind of focusing on these bars on the right, and I'll just very broadly give you a market update. Long story short, in 2021, really stocks continue to be up across the board. So I focus on that purple solid bar. U.S. large cap stocks represented by the S&P 500 up nearly 29%. Just in the fourth quarter alone, they were up 11%. So obviously, when we're looking at these different return assumptions and the actuarial reports, this is a big part when we look at, since March of 2020, the market's been strong, obviously. Real estate was also up substantially, up 39%, which was a big reversal, of course, from 2020, where there's been more of a demand for commercial real estate. You can see commodities up, as well as U.S. small cap stocks and developed international, although not up as substantially, and you can see still positive for the quarter, but not as much. The big reversal, of course, from 2020 was bond returns, and I would say that really is not just for 2020, but previous years that we've seen recently. Bonds were flat for the quarter, down 1.5% for the year. Why is that? Well, in the first half of 2021, really interest rates rose. When that happens, bond prices fall. We have seen bond prices continue to be negative here so far in 2022, but a lot less negative than stocks, or in other words, they've added a cushion to returns. Just the very next page, I'm going to focus on kind of that bottom center box where it says YTD 2021. Again, large cap stocks represented by that top row really led the way, with large cap blend being the very best performing part of the market. Small cap growth was only up 2.8%. When you look on the left, just fourth quarter alone, again, large cap led the way. That time it was large cap growth led by technology. Small cap growth stocks were essentially even. So another reversal, of course, when we looked at compared to 2020, and the reason that is just the very next page, Tracy, we show the different various sectors in the S&P 500. Energy and financials, as well as real estate, really led the way in 2021. That would be quite a bit different than when technology led the way in 2020. So these value-oriented sectors that typically pay a dividend substantially outperformed. And it makes sense, right? I mean, energy, a lot of times that is based on oil prices and demand for travel. We started to see more of that demand for travel in 2021. Also, rising interest rates typically is good for financials and these larger banking institutions, which we also saw in 2021 as well. So really across the board for stocks, it was a substantially a nice year. And again, bonds were fairly mixed, slightly down, but we really appreciate the impact of bonds in years like 2022. I'll skip ahead to page 9, and you should see it says Economic Outlook there at the top in blue font. Just kind of things that we're thinking about going into 2022 from an economic standpoint and how these drive the market. First, I'll start with headwinds or challenges there on the left. Obviously, and I would say this is that much more of a concern around the holidays than now, but obviously the different variants of the virus. And if the economy can continue to reopen, specifically within certain industries like manufacturing, to continue to run efficiently. Inflation, I'd say, is a big word in late 2021 and 22 as far as rising prices. The CPI, which stands for Consumer Price Index, was actually up at a 40-year high when we were looking at year over year at 6.8%. And I'll very briefly hit on a slide that talks a little bit more about that. And then the central bank has been a bit unpredictable as far as they've hinted at rising rates, but how quickly are they going to do that? The market doesn't like surprises, and so that's actually been part of the volatility here in 2022 as well. Just very briefly, the tailwinds we're seeing, consumers continue to be very, very strong from a balance sheet perspective. household balance sheets continue to be the strongest ever, and there's various factors for that. I think people have saved their money. There's been stimulus. There's been lower costs in order to try to increase that demand. So we think that's a big positive with consumer sentiment and confidence in general. Fundamentals continue to be strong, especially with a lot of the larger organizations or companies across the United States, fairly strong earnings, and companies continue to do a lot while being efficient. And then the tight labor markets have pushed wages higher, which we think will hopefully continue to be a trend of people returning back to work and keeping these companies as efficient as they have been. Last but not least, I'll just hit on page 11 as far as the market update. This is a really interesting one. Essentially what it says is, again, CPI, or the Consumer Price Index, was at 6.8% year over year in November, which essentially means costs substantially increased for over the last year. The CPI is made up of, you can see only 14%, that pie chart on the left, motor fuel, used cars and trucks, new vehicles, energy services, but that 14% drove over half of that CPI increase. And I think a lot of us are feeling it, yes, at the gas pump, but really for new and used cars. You're seeing all sorts of posts, whether it's on Facebook, of people not wanting to turn their lease back in, but sell it on the secondary market. We've got a couple auto dealerships as clients here in the Midwest and in Michigan, and they're definitely feeling that as far as, yes, the prices, but also lack of supply too. So just kind of interesting from an inflationary standpoint. So I will pause there from an economic perspective and just ask if there's any questions. So if you're curious now, year to date through last week, the S&P 500 is down about 7.5%, with mid and small cap stocks down about 8 or 9. International is actually down a little less at about 6, and the Barclays Ag, which is bonds, is down about 3.5%. So as I alluded to, always many reasons of what's driving market returns. Number one, I would say the Fed hinting on rising rates, and obviously the concerns around inflation, how quickly they may raise rates. Number two, I think is the obvious one, is Russia invading Ukraine and concerns around that. Not necessarily based on the economies within Ukraine and Russia in general, but how that might spill in, obviously, to the rest of the world, but specifically with Europe, deeming how much they really depend on Russia, at least for oil and oil supply from an efficiency standpoint. So obviously something we're monitoring and taking a look at, but more of a volatile market so far in 2022 than when we looked at it at 2021. Next, I will skip ahead to the actual quarterly report as far as the numbers for the retirement system. So page 18 just shows the asset allocation, and then we'll of course skip to asset values. So they're kind of on the bottom of page 18. It should say asset rebalancing analysis. And still 45% fixed income, 55% equity. You see the rebalancing schedule still would be on par, meaning if we had rebalancing, it'd be at least 5% off of targets, which we don't have at this time. Page 19 shows market value. Again, this is as of December 31st, and we'll have a more updated value for you at the end of January, but just over 190 million, 382,922. And then page 20 shows returns. So the last quarter alone for the retirement system was up 4.07%, which again, we'd look at as a pretty substantial return for the current asset allocation. The 2021 year-to-date return was 10.92%, and if you think about it, that also included some transition time where a lot of the retirement system was in cash. So a pretty substantial one-year return there as well. And then you see the 3, 5, and since inception. So your large cap stocks really led the way in order to drive this return. And again, bonds were fairly muted, although both of your bond managers outperformed their respective index in 2021. And that's really more meaningful for Loomis because you've held them throughout the year. PIMCO low duration was kind of a later add. I guess I'll add my commentary now because I think it would be appropriate when we were talking about assumed asset returns with Gabriel Roeder. I would say for your asset allocation, there's really two different things to consider, right? There's something we call expected or assumed returns, And typically that's using more of a 7 to 10 year time frame. So I think when actuaries, they say, you know, we're seeing this range of assumed returns, it's not only what's being used by pension plans, whether it's public or private, but also firms like Cap Trust, when we're saying, hey, this is our assumed rate of return, we're really looking at a shorter time frame. I think what's also important to note is historical returns have been substantially higher than what we're assuming right now. And with a long-term pension plan, that's an important piece to balance. And I think after the study is run, something obviously worth revisiting, but I think sometimes that's lost in these conversations where we say, you know, well, 6.5 seems high. And we would agree when we look at a balanced portfolio, or in other words, 55 stock, 45 bond, 6.5 would be more than what we'd say for an assumed assumption of 7 to 10 years. It would actually be lower, though, than what we've seen historically. Does that make sense? So I don't think you always want to have a knee-jerk reaction to just what we're assuming, because we do think the next 10 years will be challenging. Why is that? Well, the stocks have continued to do very, very well, and bonds have done well, and interest rates continue to be low. When interest rates rise, bond prices fall. In other words, it's just an interesting 7 to 10 years. But you just got to keep in mind, when you're using assumed rate of returns for a long-term pension plan, you don't want to mute your returns too much, I'd say, by moving one way or the other. And I would agree, I think Stan was what said it, one of the pieces of that assumption is how much the city wants to contribute on a longer-term basis as well. So if you drop your assumed rate of returns, that's one of the pieces that might obviously up the required contributions. So I realize that's going to be a future conversation, but I did want to add a little clarity. When it's spoken of ranges of assumed rate of returns, that really is looking at what we would call as a shorter time frame, 7 to 10 years versus maybe what we've seen historically. Is that helpful to everybody too, just from a asset allocation conversation standpoint?
Yeah, Jeremy, it makes a lot of sense to me, and I guess I try to think about how do we dollarize it as we think about how much risk or opportunity we have. Because on one side, we have the $20 million buffer. Feel good about that, and that's from the past great returns that we haven't realized yet in our planning. And then how much risk do we think there is coming out of that over the next several years? Because we've been running at, I don't know, 12% or more a year. We've been in double digits right over the last few years. So does that mean we should be expecting 2 to 3% for the next few years? And just kind of how do we balance that risk? And I was hoping our actuary would be able to help us think about, you know, volume-wise, how much to bring that in, but.
Yeah, and if I'm not mistaken, I think like MERS assumed rate of return is over 7%. I mean, so I think the range stretches higher, you know, but of course we have to take asset allocation into account too. But from an asset management standpoint, how we manage these expectations is we'd run more of like we call a Monte Carlo analysis of, hey, here's our expected returns over this market cycle, 7 to 10 years, here's historical, and let's look at the upsides and downsides. We call it, you know, the 5% scenario in the up, the 5% scenario in the down, and how do we feel comfortable somewhere in the middle. I think just what's unique about a pension plan or a public pension plan is downside's one thing, but it's also the contribution that's required when certain decisions are made. You know what I mean?
Yep.
So. Yeah, good question. And page 22, I think does a nice job of really reiterating part of what Ed had just stated. So if you look at the very bottom, the 3 and 5 year return, 3 years up 15.14%, 5 years up over 10.5%. We just do not think long-term that's sustainable. That's been very good market returns. But again, when we're talking about a disciplined investment strategy to support a long-term pension plan, we also don't want to necessarily say we want to lock in these gains because it's very hard to time the market, and a lot of things continue to look attractive from a valuation standpoint. It's just that's what long-term investment strategy is all about. So I'll skip ahead, and please feel free to interrupt me with any questions as we go on, but page 28. And this is our scoring methodology for the retirement system. So each investment manager is scored on quantitative and qualitative data. If the score comes to 80 or above, we mark that fund in green, which means in good standing. A yellow triangle means it scored between 70 and 79, and we mark for review. And red is consider for termination. Now, typically, we don't have a hard or fast method. This is a tool, right? And so we want to just understand, hey, what drives that score and what different considerations are going on. Typically, when there's a score that's marked for review, we put some commentary in the report. And so if you just want to turn to page 30, so just, I think, 2 pages up, this actually documents some of the criteria or the commentary that we'd give. So I'll start with the third fund down. Again, PIMCO low duration, which scored as a 72. It essentially says the fund actually continues to perform very well for its expectation, but it has something called a shorter duration, meaning it's not going to grow as much over time, but it's less interest rate sensitive when interest rates change. Only about a quarter of the bond portfolio is in PIMCO low duration. The rest is in Loomis sales. Which is quite a bit more, I don't want to say volatile because it's a bond fund, but it would have more of a duration, so we really like how the two pair together. So the commentary essentially says, yes, when we compare to other bond funds, this fund isn't hitting it out of the park, but there's a reason it was implemented and the manager's doing their job. So we'll just, again, continue to revisit that. Goldman Sachs small cap value, there's performance on each and every one of these funds, but I'll just tell you, they are a high-quality manager that will buy stocks with low valuations. They want companies that have competitive advantages, strong balance sheets. They're not trying to chase trends. And it's the lowest quality stocks that have really rallied in late 2020 and early 2021. That is not an environment that Goldman typically outperforms. They really do very well in down markets and through various market cycles. So they continue to be in the top 40% of managers for the last 10 years. But I will say when we have rockier environments like we do here in the first quarter so far, that's typically why we like a manager like Goldman Sachs small value, because they have less of we call it a beta, but less volatility than your average manager. So again, it just essentially wraps up that commentary that says we believe holding the strategy or clients holding the strategy should continue to do so. No material concerns, but of course it's our job to help you monitor these over time. So I will pause there and make sure there's no questions. And just very briefly, we'll skip ahead to page 51. And this is now what we call the January 31st flash report. And obviously January, I shouldn't say obviously, but the beginning of 2022 has been a bit more rocky of a market, and there's been negative equity returns. So the total portfolio at that point was 182.1 million, and again, that was down from about 190 million at the end of Q4. Page 52, no big substantial recommendations for rebalancing. In fact, when we have a market correction like that, it really does some natural rebalancing from a stock standpoint. And then page 54, just down on the bottom left, shows the month-to-date return down about 4.19%. Really, assets in general were down across the board, but your fixed income managers, or in other words, your bond managers, were down 1.64, where your average stock manager is down about 6. So again, bonds were the reason for slightly muted returns in 2021, but environments like this, they obviously add quite a bit of value. All right. So last but not least, if you remember from our last meeting, which does seem like a while ago, I know, but page 44 of the presentation just talks about cryptocurrencies, or in other words, digital assets. If you remember, this was brought up really in our last meeting, I believe by Jake, because there's been a couple headlines out there that talk about public plans investing in cryptocurrencies. We have been keeping an eye on these developments. I would say from a fiduciary standpoint, we still really don't have comfort around implementing cryptocurrencies or digital assets, and this presentation goes into why. We are seeing more of a demand from a personal financial planning or an individual wealth standpoint where they're implementing small allocations, but again, they're not a fiduciary over a large pool of retirement assets. It's also just important to shed some light on kind of the relativity of the positions that are being implemented. So for example, the big headline that we had saw a few months back were the Houston Firefighters Relief and Retirement Fund. They did purchase a $25 million position, mostly in Bitcoin, but their plan assets were approximately 4.6 billion. So in other words, that was a little less than 0.5% that was implemented. And because of their size, they're able to access managers that actually will manage the cryptocurrency along with some other what we call alternative strategies. And some public plans have more flexibilities around their acts than others in order to do that, right? So I want to just kind of reiterate, some of these pension plans aren't just implementing at their traditional custodians like a Comerica, because that's really not a capability. They're doing it through private managers or even hedge fund type strategies where they can implement that underlying cryptocurrency. So just something to think about from a relativity of size standpoint. I know one of the natural questions is, have we seen it implemented in public plans in Michigan? And we haven't. That doesn't mean that it won't happen at some point, or if there wasn't a bigger story out there, that there could be a trend. But just from an overall comfort standpoint, we haven't seen it catch on like the headlines might allude to. But I think it's very important just to keep up on, obviously. We do see advantages to cryptocurrency or digital assets. I'll take just a step back because I think there's, especially with cryptocurrency, there's a huge wide range of knowledge or kind of buzz out there of what the advantages or disadvantages are. So I think it's helpful to just look at that column on the right. But essentially says certain cryptocurrencies are traded between users on a peer-to-peer blockchain without the need for a central location or middleman such as banks. So when we talk about digital assets, typically if you go to the bank and you want to withdraw your money, you can get something physical for that, right? Physical US dollar bills or coins. If you have bars of gold or any type of commodity per se, many times these are physical, what's different is Bitcoin would be pure digital versus physical. And then it goes on to say a blockchain is a database of public records, essentially that's maintained collectively by independent users. So specifically with Bitcoin, certain opportunities we think there are for growth is there's potential to store value over time, and there is a limited supply or chain for what's out there, so of 21 million, and that's capped. That would not be the case for other cryptocurrencies out there per se. Diversification is huge within any portfolio, and we have seen, although we have limited history, that cryptocurrencies could act quite different than your traditional securities of stocks and bonds. And then there is a growing ecosystem, meaning companies are starting to make larger investments in the space, whether they're investing in it or just the technology to support it. And you can see we put a MasterCard quote there, digital assets are becoming a more important part of the payments world. From a consideration standpoint, I think this is obviously the big one. They can be extremely volatile based on what digital asset you're investing in, but we'll just stick with Bitcoin. As a potential emerging asset class, they have had extremes ups and downs. So it was interesting, I kind of looked more near where we last met, where Bitcoin at the end of October was at 37,700. Currently, at that time, at the end of October, is at about 70,000, meaning it's come down almost 50% in value since late fall, and that would be similar message to Ethereum or some of the other cryptocurrencies as well. Again, we could see that ride back up, but very, very volatile, and they're difficult to manage just based on some of these trade disruptions because they're not on necessarily the regulated open market. And they're hard to store as well. So multiple layers of security are needed, public keys, private keys. There are also risks of these keys being lost or stolen. And you think of a key, obviously, like a physical key, but they would be essentially a digital key that would be coded in a specific or certain way. And then it just goes in to say, at this point, the SEC has stated due to Bitcoin's decentralized nature, it's not a security. Currently, there's not a Bitcoin ETF or mutual fund that's out there, but we think that could develop over time, which would make it just a little bit more reasonable or fathomable for a retirement system at a certain time to maybe diversify some assets there. But if you think about the Public Act too, it's not going to reflect currently digital assets in general. It gives more of a 5% bucket for what we call other assets, which we like to have for investment managers that might be in the gray area or black and white as far as things that are limited as far as to be invested in. So To summarize on page 46, I don't want to blab too far on you, but we think there's definitely growth potential and value in digital assets, especially some of the more developed ones like Bitcoin. But as far as the history, they're not insured by the SIPC or the FDIC. There's obviously a history of volatility, and I say history lightly because we're talking about asset class assumptions for the retirement system that we can look at 50, 60 years. We just simply don't have that with digital assets right now, right? So as any fiduciary such as us, we like to have more history under the belt in order to make an informed decision. Bitcoins are not legal tenure. So again, federal, state, or foreign governments may restrict, and I want to just tie that back to the Public Act and how acts are different across the country. There are security concerns from theft still. We think some of these are being improved, but when we have such a focus on cybersecurity in the retirement plan industry, that does bring grave concerns for institutional assets. Again, individuals can kind of take their own risks from a personal standpoint, but when we're talking about retirement funds, we'd look at that as different. And again, it's just new and developing. There's not much of a track record. So, does the board find that helpful just from a general overview?
Yeah, thank you.
Great.
Yeah, it'd be something definitely to keep an eye on, and
Yep.
I hope we can keep seeing Houston's. I'm curious to see kind of how that ends up in 5 years and
Yep.
and where they go with that, so.
Absolutely, absolutely. It's a fascinating asset class and type of asset that, again, when we talk about companies like MasterCard investing that much more money into their technology to support it, it's exciting. So I'm going to flip back to the agenda, but I think we are, we're all set on our end.
Anybody have any questions, Jeremy? Okay, thank you, sir.
All right,
Appreciate it.
good to see everybody.
Public comment. Nancy, do you have anything?
Nothing, thank you.
Okay. Next meeting, March 21st.
I'm a yes.
That works for me.
Works for me.
It shall be the 21st.
That was easy. How about you, Jeremy?
Yeah.
Yeah, thank you. I hate to end that streak.
That was too easy this time around. Okay, well, I guess we'll adjourn the meeting. Thank you all.
Thank you.